Social Accounting Matrix, SAM, Relationship and Circular Flow of Economic Activities. Meaning of SAM. SAM originated from the pioneering work on national accounts by Mead and Stone, 1940, first SAM developed by Nobel laureate Richard Stone for the UK in 1962. Work on developing countries started in the 1970s. A social accounting matrix, SAM, is a comprehensive data framework, typically representing the economy of a nation. A SAM is a consistent and complete data system that captures the interdependence of socioeconomic system within a framework. It shows both the input-output relationship within the economy and national and external accounts in a consistent framework. It displays the total transactions undertaken within an economy on a specific date. More technically, a SAM is a square matrix in which each row and column is called an account. The underlying principle of double-entry accounting requires that, for each account in the SAM, total revenue, row total, equals total expenditure. From an accounting perspective, the SAM is a two-entry square table which presents a series of double-entry accounts whose receipts and payments are recorded in rows and columns respectively. The SAM represents the whole economic system and highlights the interlinkages and circular flow of payments and receipts among the different components of the system. A social accounting matrix, SAM, can be defined as a presentation of the system of national accounts, United Nations 2009, in a matrix format. Not only the process of producing goods and services is presented in a matrix, usually referred to as input-output tables and supply and use tables, but also all other, non-financial and financial transactions and positions. Doing so, a SAM elaborates the linkages between the production process, including the generation of income by producing goods and services on the one hand, and the processes of income, distribution, consumption, capital formation, and financing on the other hand. SAMs are closely related to national accounts, whereby their typical focus on the role of people in the economy may be reflected by, among other things, extra breakdowns of the household sector and a disaggregated representation of the labor market. A social accounting matrix, SAM, elaborates the interrelationship between economic and social statistics by linking together the, mainly, macro statistics of national accounts with the, mainly, micro statistics of the labor market and of households. SAM emphasize the linkages between supply and use tables and sector accounts, and their focus on the role of people in the economy. Features of a SAM: full coverage, harmonized concepts, consistency, good quality data, flexibility, timeliness, transparency, full coverage. Accounting systems should be exhaustive, within the defined scope. It cover all economic activities within the production boundary as defined in these national accounting systems. The accounting systems should cover persons and all the jobs that they hold. Variables that are closely related must be measured coherently, so that the important differences between them are retained and measurable. Harmonized, coordinated, concepts. As with coverage, to achieve coherence in SAM, the concepts and classifications used in the accounts have to be harmonized and mutually consistent. This harmonization is crucial when combining statistics from different sources and from different accounting systems, and when comparing results from different countries. Consistency. Accounting systems provide sets of estimates that satisfy strict identity relations. This consistency is, usually, a consequence of the account compilers making informed adjustments to the source data. It is more efficient for the accounts to be made coherent once, by the compiler, rather than by a variety of different users, who will use different assumptions, and therefore produce different results. The information on how these coherence adjustments have been made should be clear and open to public scrutiny and challenge good quality data. Comprehensive accounting system built on statistics from a variety of sources, including administrative sources, enterprise surveys, and household surveys. This helps to produce good quality information in both the accounts and in the source data themselves. Firstly, each source has strong and weak points that are known to the compiler, and the system can use the sources in a way that makes use of the strong aspects of each source, thus improving the quality of the accounts. Secondly, where different sources provide alternative measures of the same concept, the compiler may be able to trace and quantify inaccuracies and errors in the different data sets by comparing them. Flexibility. Accounting systems are flexible because their scope can be extended to include other concepts or more detailed information, providing these do not conflict with the logic of the system. It enriches the national accounts by elaborating the linkages between supply and use tables and the sector accounts, using detailed breakdowns of the sectors and subsectors. It incorporates additional information on the level and composition of employment. Satellite accounts, such as environmental accounts, or a combination of a SAM and environmental accounts, also enhance the scope of the national accounts framework. Timeliness. Integrated statistics may, at first glance, seem less timely than the results of source statistics. Experience with national accounts has shown that the availability of an accounting system in fact facilitates the estimation of reliable and timely short-term business cycle indicators. Because of timely statistics into the accounting system, makes it possible to update the rest of that system with the help of the required consistencies and estimates for previous periods. This approach can provide the best possible early estimates of aggregate indicators. At the very least, the use of accounting systems ensures the release of provisional estimates that are mutually consistent. Transparency. During the process of integration, many decisions have to be taken to adjust results from the various data sources used. Documenting and publishing the different steps taken in the process allows the adjustments to be challenged and improved where necessary. Although this activity requires considerable resources, it stimulates quality improvement by forcing producers of integrated statistics to justify their decisions explicitly and to document their judgments. The source statisticians are then able to comment on the adjustments made to their statistics. Objectives: organize the information on the social and economic structure of a country for a given period. Provide a synoptic view of the flows of receipts and payments in an economic system. Form a numerical basis for building models of the economic system, with a view to use this to simulate the socio-economic impact of policies. Importance of SAM. An aggregate matrix can present a bird's-eye view of an economy as a whole, i.e., one page is sufficient to show the interrelations between main transaction categories leading to a set of domestic and national balancing items. Each entry in an aggregate matrix can be considered as the grand total of a detailed submatrix which shows the different categories of transistors involved. In a matrix presentation of accounts, different types and groupings of transactions can be selected in each account, without giving up the coherence and the integrated presentation of a complete accounting system. This means that multiple actoring and multiple sectoring can be used. By choosing in each account a unit and a classification of units which are most relevant to the set of economic flows under consideration. An accounting matrix always describe a complete economy. A detailed matrix presentation is suitable for mathematical treatment using matrix algebra. This can also be of help when balancing the accounts. A detailed matrix presents a simultaneous breakdown of interrelated transactions by paying and receiving units. As a consequence, it is an appropriate format to reveal, at a macro level, interrelations among economic flows. This includes those flows which involve two different types of units, e.g. final consumption expenditure of various categories of goods and services by a number of household subsectors. For a set of accounts giving a breakdown of transactions by paying and receiving units, a matrix presentation is more concise than other methods of presentation. The payment of one unit and the receipt of another unit involved in each transaction are represented by a single entry. An aggregate matrix can present a bird's-eye view of an economy as a whole, i.e., one page is sufficient to show the interrelationships between main transaction categories leading to a set of domestic and national balancing items. For a set of accounts giving a breakdown of transactions by paying and receiving units, a matrix presentation is more concise than other methods of presentation. The payment of one unit and the receipt of another unit involved in each transaction are represented by a single entry. Elements of SAM: activities, commodities, factors, institutions. Domestic non-government institutions, household consumption, the capital account, rest of the world, ROW, account, government income and payments. Activities. Activities are the processes undertaken to produce commodities, goods and services, within the village economy. They generally refer to a defined sector such as agriculture, mining, or services. When selecting activities for the construction of a SAM, the data can be collected at any disaggregated level. Activities produce goods and services by combining the factors of production with intermediate inputs. This is shown in the activity column of the SAM, where activities pay factors of production the wages, rents, and profits they generate during the production process. Commodities. Commodities are the outputs of the activities and can take the form of goods and services. Activities and commodities are separated because it permits an activity to produce multiple commodities. For instance, a dairy activity may produce the commodities milk and cheese, or intercropping may produce maize and beans. Similarly, a commodity can be produced by more than one kind of activity. For example, activities for small-scale and large-scale maize production may both produce the same maize commodity. Commodities are either supplied domestically or imported. Values in the commodity accounts are measured at market prices. Commodities are purchased by a number of economic entities. Factors. Factors are assigned to production accounts and depict receipts from activities. They are usually covered by labor and capital, but can also relate to natural resources such as land and water. Single factors may be further differentiated, for instance labor according to gender or quality. Institutions. A SAM is different from an input-output table because it not only traces the income and expenditure flows of activities and commodities, but it also contains complete information on the accounts of different domestic institutions, such as households, enterprises, and the government. Households are usually the owners of the factors of production, and so they receive the incomes earned by factors during the production process. They also receive transfer payments from the government. For example, Social Security and pensions, and from the rest of the world, such as remittances received from family members working abroad. Households then pay income taxes to the government through the taxes account and purchase goods and services from the commodity account. Households and enterprises transfer payments abroad to the rest of the world respectively, and enterprises transfer surpluses to the government. The government uses these revenues to pay for recurrent consumption spending, for transfers to households and financial and non-financial sectors, and to send transfers to the rest of the world. A SAM also contains complete information about different institutional accounts. Institutions in the SAM context mean economic agents and normally comprise households, companies, small and large businesses, NGOs, and the government. Institutions are the economic agents who undertake production and consumption activities within the economy and reflect either human or legal entities. However, households are the main actors in a village SAM. Domestic non-government institutions. Domestic non-government institutions consist of households and enterprises. Enterprises earn factor incomes, reflecting their ownership of capital, and receive transfers from other institutions. Enterprise incomes are used for corporate taxes, enterprise savings, and transfers to other institutions. Unlike households, enterprises do not demand commodities. In the SAM, enterprises are an aggregation of financial and non-financial corporations, as defined within the System of National Accounts, SNA. Household consumption. Next, a SAM distinguish between home, own, consumption of activities and marketed consumption of commodities by households. Home consumption, which appears in the SAM as payments from household accounts to activity accounts, is valued at producer prices, i.e., without marketing margins and sales taxes that may be levied on marketed commodities. Final household consumption of marketed commodities appears as payments from household accounts to commodity accounts, valued at consumer prices including marketing margins and taxes. The capital account, investment internal, saving investment or accumulation account, records the allocation of resources for capital formation. It describes the use of resources for purchasing investment products and building up stocks of goods. Rest of the world, ROW, account. The ROW account describes transactions that go beyond the border of the domestic economy. The row records payments by the row from the economic system, e.g. imports, and the column records the payments to the row towards the economic system, e.g. exports. Government income and payments. The government in a Nexus SAM is disaggregated into a core government account and various tax collection accounts. Tax accounts are necessary since otherwise the economic interpretation of certain payments becomes ambiguous. Direct payments between the government and other domestic institutions are reserved for transfers. Payments from the government to factors are captured in the government services activity. Government consumption demand is a purchase of the output from the government services activity, which in turn pays labor. Sample of SAM. SAM framework activities commodities factors institutions capital rest of world SAM offer seats activities marketed production home consumption activity income, gross output. Commodities intermediate demand consumption expenditure investment demand, stock change. Exports total demand factors validated payments from labor outside total factor income institutions factor income, payments to households. Inter-household and social transfers remittances received from outside total institutions income capital savings current account balance total savings rest of world imports payments. Total outside remittances transfer at outside current account balance foreign exchange outflow sum of payments gross output total supply total factor expenditure total institutions. Expenditure total investment expenditure foreign exchange inflow. Sample of SAM. Warning, empty page.